This is Debt Free in 30, where every week we take 30 minutes and get practical advice from industry experts about personal finance and living debt-free. Here's your host, Doug Hoyes.
Yes, this is Debt Free in 30, and I am Doug Hoyes, and on today's show, I have a first-time guest who disagrees with some of the advice I gave in my new book. I'm a big boy. I can take some criticism, so I've invited him on the show today, and he can give his opinion. I'll give mine, and we'll have a big fight with lots of yelling and screaming, and then you, the listener, can decide who is right. So before the yelling and screaming starts, here's the background. As everyone who listens to this podcast knows, I wrote a book, Straight Talk on Your Money, and in that book, I described 22 financial myths. Myth number 4 is all about credit scores, and one of the subtitles in that chapter over on page 48 is The Credit Score Scam. So it would appear that I am not a big fan of credit scores. In fact, in the practical advice section of that chapter on page 52, I say that you should not focus on your credit score. So it would appear that I don't think your credit score is important. That's the starting point for today's argument. My guest sent me an email, and here's what he said, and I quote, "I noticed when reading your book, we do not completely agree on the importance of one's personal credit history," end quote. So, what's the disagreement? Let's find out. It's time to welcome my guest. So, who are you and what do you do?
Hey, Doug. It's Ross Taylor, and I'm a mortgage agent with Concierge Mortgage Group, and I specialize in bad credit mortgages, difficult mortgages in general, where there's something about the file that would mean the applicant could not get approved at a bank.
Excellent. Well, I appreciate you being here today, Ross. In fact, we're in your office. We're near Dufferin and Steeles in North York, and so we're going to find out why you specifically object to what I've said in my book. So I'm going to turn it over to you, give you the microphone. Tell me in simple terms why you think I'm off base in saying that a credit score is a scam.
It actually caught me by surprise to hear you say that, Doug, because I've lived my life and brought up my children to believe the exact opposite. One of my daughters used to tell me that she would have nightmares and wake up thinking that she'd missed a payment on a credit card and the wrath of Ross was going to come down upon her. Life's just more difficult when you have a bad credit history. It's not just about mortgages. If you go to rent an apartment, for example, most landlords are going to want to look at your credit history. And if you haven't paid attention to that, you could have difficulty getting that apartment. You may be asked, in fact, for 6 months or even 12 months prepayment of the payments. Even insurance on your home and your car, your credit report can affect it. When you take out a cell phone, they check your credit, and they may not give you that 2-year plan with all the bells and whistles if your credit history is subpar. And yes, of course, with mortgages, the bigger and better and the cleaner the credit history, the more likely you are to be approved and at decent rates and terms. Another aspect that can be affected is student assistance, OSAP, student lines of credit. Such an important part of the fabric of today's society with everybody needing help to get through their higher education. If you have messed up credit, you may not be able to qualify for that assistance. So these are some of the reasons why I think it's important.
So, okay, and I get what you're saying. It's not just you're not going to be able to qualify for a mortgage. It affects many other areas of your life. You listed them off: renting an apartment, getting insurance, cell phone, as well as the obvious things like mortgages and other loans. So let me give you my take on this. And I'm not going to read long passages from the book because, hey, the book's available as an audio book on Audible and iTunes, and I don't want to, violate the copyright by reading the whole thing. But let me summarize my basic point, which is that a credit score is for the benefit of the bank, not for you, the borrower. It's a way for them to determine risk when they're lending. It's a way for them to determine how much money to lend you. So in order to get a high credit score, you actually have to have debt.
Correct.
So if you've never had any debt, then you're not going to have a high credit score. You probably won't have any kind of credit score. So if you want to play the game and get a high credit score, then you have to have some debt. So somebody with 2 credit cards but a low utilization is going to have potentially a better credit score, all else being equal, than someone with one credit card and a low utilization. Now, whether someone with 15 credit cards is going to have a better credit score, of course, is open to debate. But my worry is that you start focusing on the wrong thing. So my advice is, instead of trying to get as high a credit score as possible, which may mean taking on more debt than you should, I think you should instead focus on what's right for you, which might include things like, saving money. So you've got a bigger down payment when you go to buy that house. And obviously savings is something that doesn't appear on your credit report. It's only debt that appears on your credit report. And in fact, it really even shouldn't be called a credit report. It should be called a debt report, because that's really what it's all
Doug,
about.
Sorry to interject here, but first of all, I don't think that the two things are mutually exclusive. You can certainly have a savings plan and also pay attention to your credit history. It's not a one or the other. And it's not so much a debt report, because you can be very responsible and have available credit. As you say, 2 credit cards is pretty much all you need. You don't have to be using it, or you don't have to have a high utilization rate. As a matter of fact, you should be paying it in full every month. You're right that it is easier and easier for people, especially with good credit scores, to tap into even more credit. And sometimes things get out of control and they end up knocking on your door looking to file a consumer proposal. I see that too. But managing your credit score is just a responsible thing that every Canadian should be doing. It doesn't have to be obsessive. And in fact, once you get to a certain point, it's a vanity project if you're continuing to try to get the score higher. I mean, the scores range from 300 to 900. And most of us fall between 600 and 750. Anything beyond 750 is gravy. It's icing on the cake that's not necessary to get the best loans or the best mortgages.
So whether I have 800 or 850 as my credit score, I'm probably paying the same amount on a mortgage, all else being equal?
You certainly are. There's no difference.
It's not going to make any difference.
No.
So the upper target, like 750, and I'm pretty good, like
750, but then again, even with a high score, there might be errors in your credit report. There might be things that are just wrong. There could be an old collection item that was never resolved or paid. And something like that could hamper your ability to get a mortgage or...
So you're not saying focus on your credit score. You're saying focus on your credit history.
Your score, your history, the content, and what comprises it.
So there's a bunch of different things here.
Yes.
And yeah, in my book, I mean, as I quoted, I have a subtitle called "The Credit Score is a Scam," and obviously that's deliberately provocative, because that's what you have to do when you write a book.
Well, it provoked me, Doug.
There you go. Yeah, absolutely. And one of the reasons, credit scores are not consistent. I can go to Equifax, go to TransUnion. It might be 2 different numbers. It will be. Yeah. The bank may be using their own internal calculation that is a combination of some other factors, whatever. So the credit score itself is, it's a target that's hard to shoot for because you don't know what the target is. But I guess your emphasis more on the overall picture, the holistic approach, the credit history as well is pretty important. The health of your credit history. So, well, okay, so let's illustrate this point then, because you wrote a blog post back in October, and I will link to this blog post in the show notes over at hoys.com, but it's on your website, which is askross.ca, and we'll mention that again at the end of the show and put links to it as well. The title of this blog post was "Huge Credit Score Increase Results in Mortgage Miracle." So you should write a book, Ross, because you're just as good at me as making, wild and crazy titles here. So in this blog post, you tell the story of a client. You called him Justin. Obviously, that's not his real name. But so Justin was actually in a consumer proposal.
Yeah, this time last year, he came to me and he was in a consumer proposal. He had a mortgage with a major charter bank. And when he filed the proposal, that bank was affected. He had a credit card and a line of credit that were included in the proposal.
So the bank was the mortgage holder on his house, and there was also unsecured debt.
That's right, Doug.
A credit card and a loan or whatever. Okay. And so the mortgage existed before he had the proposal and was obviously still in place while he was in the proposal. And I assume, I don't know this guy, but I assume that the equity in his house was less than what he owed in total, or else he wouldn't have filed a consumer proposal. I guess he would have got a second mortgage and paid everything off to begin with. But
that's right. The market's been wonderful in the GTA the last few years. Yeah.
So the value of the house continued to increase. So he came to see you well into his consumer proposal. It had been up and running for
at least 2 years.
At least 2 years. Okay. And so tell me what happened next then.
Well, he expressed concern to me that his bank had already warned him that when his mortgage comes up for renewal, that they would not be offering him renewal.
Now, just before we go on there then, so let me jump on that point. Is that a common thing you see?
Actually, no.
Okay.
If anything, I'm always impressed or surprised that banks tend to renew mortgages for debtors that are bankrupt or in proposals without any hassle. It's just an automated process. As long as the mortgage repayment history has been excellent, they don't go troubling you.
And why do you think that is? Because it's an automated process?
It's an automated process. They do not do a new credit check if they're renewing. If you poke the bear, if you decide, you're in a proposal or a bankruptcy and you want to ask the bank for more money because, heck, you've been a customer for 20 years and they must love you, then you might be in for a shock because now they have too much information and they're looking and they're assessing your situation, and they may think twice, not only about they certainly won't give you any more money. They may wonder whether or not they even want to keep you as a mortgage client.
So I guess there's even a question as to whether the bank would have renewed the mortgage in a couple of years when it came up, or was this just some, low-level bank employee saying, well, we're probably not going to renew it. But
it was enough to spook the guy.
It was enough
You're
to
right.
spook
It may not have been valid.
Might not have been real. So in your experience, though, if you are in a consumer proposal or even in a bankruptcy and you own a house and you're making your mortgage payments, keeping them up to date, it is likely that the renewal will go through no problem in, a year or two or three, whenever it comes up, provided you've made all your mortgage payments, you're not behind on any mortgage payments. That's traditionally what happens.
That's correct.
Okay. However, in this particular guy's case, and I'll let people read the blog post for all the full details, but he had a couple of different issues. The first one being, well, I'd like to get this proposal paid off, and I'm worried about whether the bank's going to renew my mortgage in 2 or 3 years when it comes up for renewal, whether what they're telling me is true or not. As you said, it spooked him. So what happened from there then? He came in to see you. What was the discussion?
He came in to see me, and he wanted to understand whether or not there were any mortgage financing options that could solve this. And I explained to him, first, there are, but almost every mortgage lender out there, even private lenders, if they're going to help someone in that situation, the proposal has to get paid off. They're not going to allow that proposal to sit there and then sort of do a workaround and lend them additional money.
So again, that's a key point then. If you're in a proposal, it is very difficult to, if not impossible, to just get a new mortgage.
Correct.
And if I don't own a house right now and I'm in the middle of a proposal and I want to buy a house, pretty much forget it. There's no bank that's going to give you a brand new mortgage to buy a brand new house while you're in the middle of a proposal.
The only way you could do that is if you had a huge down payment. Maybe you won a lottery or got an inheritance or something like that. If you could bring at least a 30% down payment to the table and pay off that proposal, then there are a couple of lenders out there that would be lenders or alternative lenders that would give you a mortgage even in those circumstances. But again, in every case, that proposal must be paid off before the mortgage is advanced.
And why is it important that the proposal be paid off? Why do the lenders want that done before they're advancing new money?
Well, lenders are in the business of lending money, but they try to do it in as risk-free fashion as possible. And if there's an overhanging debt of such significance, it just doesn't sit well with them. They want to see the rehabilitation process has been completed.
And I guess that kind of makes sense because the typical proposal we would do, the debtor is going to pay somewhere between, let's say 30, 40, 50 cents on the dollar. Every situation is different. If the proposal fails, well, then they owe 100 cents on the dollar. So if I'm a bank,
go right back to $1.
You go right back to $1. So if I'm the bank wanting to lend a mortgage, it's like, well, if you pay the mortgage off, then I know it costs 30 cents, but if you don't, it could cost 100 cents. I don't want to take that risk. So it's like you said, it's a risk minimization thing. So okay, back to the story of Justin then. He's in a proposal. He comes in to see you and continue on from there.
And we looked at his situation. Now, whenever I get a client like this, I have spreadsheets that I've built, and I do an analysis to see what are the options. I can always get a new first mortgage for these clients, even at that moment, as long as there's sufficient equity. But I look at that and the cost to the client of doing so and the benefits, and I also look at perhaps getting a private second mortgage, leaving what they have in place already for at least another year, getting a private mortgage, paying off the proposal and whatever else he wants to pay. This fellow also wanted to do some home renovations last year, which we were able to finance. So we do the assessment. Now, one of the reasons we chose to do a second mortgage at that time was there was at least 2 years left on his mortgage. And one of the unfortunate things about bank mortgages is the prepayment penalties can be pretty high, especially if there's a few years left to maturity. So that was what deterred us from doing a new first mortgage last year. We decided instead, leave it alone, take 1 year off the clock, and get a second mortgage. We paid off his proposal. We financed some home renovations. And incidentally, we reduced his monthly outlay. The monthly payment on the new second mortgage was less, as is usually the case, than the proposal payment. So he really felt that he'd taken on a winning solution.
And I guess mathematically the reason for that would be, well, it's a mortgage that runs for 5 years or whatever period of time.
Well, actually, the good thing about private mortgages is almost all of them are just interest payments only. So yes, the interest rate is high. There's no two ways about that. But most of us in society today are concerned about cash flow. That's how we look at cars. Like, what's the monthly payment? That's how we look at mortgages, rightly or wrongly. And it's the same thing here. From a cash flow point of view, Justin's monthly nut went down as a result of the second mortgage.
Gotcha. So what, in effect, you did was you put him into a holding pattern. It was like, okay, we're going to pay off the proposal. And I don't know if you hit this point or not, but the reason for paying off the proposal is what? The bank wouldn't have advanced the money anyways, but what were the other reasons why he wanted to get that proposal paid off?
Well, most debtors understand that 3 years after the completion of a proposal, it will fall off your credit history, the fact that you were in that proposal. So that clock doesn't start ticking until you're discharged or you've completed the proposal. And I find that people that have the means to pay off the proposal, they really want to put everything in the rearview mirror, just like it never happened. Like, get that blot off their personal life.
So it was a case of, I want to get the clock started. There's this 3-year clock. So the sooner I get it started, the sooner it finishes. Now, my counter argument to that, and let me fully disclose my biases here. I love it when people pay off their proposal because as a consumer proposal administrator, I get paid as the payments are being made out to the creditors. So if someone comes in and says, wow, there's $10,000 left on my proposal, here you go, my mother gave me the money, I go, fantastic. Now I know for sure you're not going to default on the proposal because you've paid it off and all the creditors are getting paid, which means I get paid. So if you want to pay your proposal off early, I love it. My worry, though, is, well, if you're taking on a bunch of debt to do it, then does that make matters worse? Because in the proposal, you're not paying any interest. If you take on debt, obviously you are paying interest. So in the case that you've described, he was only paying interest, so he wasn't affecting the principal amount. The interest rate was, I mean, it wasn't prime rates. He wasn't paying 2% or anything like that.
Typically, they'll be between 10 and 12%.
So it's a pretty high interest rate. So I guess if Justin had come to me, I would have said, well, okay, but you realize, I mean, I'm happy for you. This is fantastic for me too, but let's say that this mortgage is going to be out there for another year.
Yes.
You're going to pay 10 or 12% interest on that money. So let's just make up numbers. Let's say it was a $10,000 amount.
No, let's use the actual numbers. It was $66,000.
$66,000. So obviously his house had gone up considerably in value. The equity had increased, which is not uncommon if you bought a house anytime between 2010 and 2017 in the Toronto area. So, 10% interest on $66,000 is $6,600 in interest in a year.
$550 a month.
$550 a month is what he ended up paying. So I'd be sitting there going, okay, $550 a month to make the clock tick a little faster. Is that really worth it?
Absolutely. Especially when you go to the second part of his story. What we accomplished in the last month or so would not have been possible if we hadn't taken that first leg of the journey 1 year ago.
Okay, so a year ago, he gets the second mortgage, $66,000, pays off the proposal, has some extra money that he can use for home renovations, whatever, which obviously increases the value of the home, I guess, too.
And it certainly did.
Okay, and so then a year later, what happens?
Well, our original plan had been to look at things 1 year out because these mortgages tend to have a 1 year term and then you reassess your situation. And we were going to evaluate whether or not just to sign up for another year or whether it made sense to consider breaking his first mortgage with the bank and collapsing the second mortgage into one first mortgage. Because that's ultimately where you want to go. You don't want to be carrying a second mortgage for any longer than is necessary.
And certainly not at 10 to 12% interest either.
It's true, and I know you're hammering that, but you said, well, why would I want that debt? Well, the consumer proposal is a debt too, don't forget.
Mm-hmm. It's an obligation, there's no doubt. It requires payments.
It's a debt obligation just as much as a mortgage is. So again, I emphasize the cash flow aspects of this. The fellow reduced his monthly payment to the trustee, which I believe was just under $800 at the time, down to $550. It's hard to tell him that's a bad thing. Mm-hmm. He was taking advantage of paper profit in his home. Basically, he was starting to take less money out of his pocket every month. He was paying off that proposal, resetting the clock, doing home renovations. He's a pretty happy camper.
So then a year later, you said, okay, we reevaluate. Yeah. Do we renew the second mortgage? Do we try to roll it in, get you a new first mortgage? Maybe there's a penalty we got to pay or something to do that. What actually happened?
Well, what actually happened was he came to me and said, we have a family medical situation and we need money, serious money, and we need it now. What are my options? Now, we're talking about six-figure money that he needed, and it really would have been gruesome. As you say, I'll buy into that, to give him a $180,000 second mortgage or something along those lines. So now I was looking at fast-tracking, converting him to a new first mortgage, not with a bank, of course, because it's just been a year since he finished his proposal. So to find an alternative lender. Is
it fair to say a bank really isn't going to look at you until at least 2 years after the proposal's been completed, or is it even longer than that?
Well, you know what? When you're talking about banks specifically, as long as they can see that proposal on your credit history, they're not really motivated to help you.
So 3 years after the proposal's done is when a traditional bank will start looking at you.
At least 3 years.
At least 3 years.
A credit union might look at you faster.
Okay, but you're talking about other lenders,
yes,
non-banks.
Very reputable lenders, such as, say, B2B Bank is a bank, or Equitable Bank, they're a bank. Home Trust Company, Exceed Mortgages, Erickson Lendwise, MCAP Eclipse. There's a good dozen or so very fine, reputable alternative lenders helping people, not just in this situation, but anybody that's a bank turned down.
So you were able then to, so what happened? Did you end up with one big mortgage at the end?
Well, that was the goal, but he brought me his personal credit report from Equifax, and before we even started, I knew we had a problem because his score was only 497.
Wait a minute, credit scores are a scam. Didn't I write that in my book here? What are you telling me?
Well, I can tell you it's not a scam. I mean, 497 score meant that my job was going to be very difficult. And
you had said that a traditional score is somewhere like really good would be 750. The top is 900. No one's ever had 900 in their life, but so 497. We're at the bottom end here. Then
we're at the bottom end. That looked like a score of somebody that was still in a proposal as opposed to somebody that was 1 year out. So
why was it so bad?
Well, it's funny you mention that. The reason it was bad was because there were a number of errors, reporting errors inside his credit report that were really dragging down his score. Things that, because credit history, they rely on information that's provided to them by the credit issuers. They take it at face value and they report it. And if there's a lot of things that are wrong in there, who's going to look out for that? Who's going to check it if it's not the consumer himself?
Yeah, because no one else cares.
Right, exactly. But he cared, and I cared, because in order to do what we needed to do, I was going to have to borrow up to 80% of the value of his home. But with a score of 497, if I found a lender...
Huge interest.
Yeah, high interest and only 65% of the value. So the project would fail.
So what kind of errors were on his credit report?
Well, for starters, I think in his case it wasn't even reported that his proposal had been paid off.
And this was a year later?
Correct.
Okay.
Secondly, a number of the items...
And just on that point, since this obviously is my area, as soon as a proposal is completed, as the trustee, the consumer proposal administrator, we do a final statement of receipts and disbursements. We issue a certificate of completion. We electronically file that with the Office of the Superintendent of Bankruptcy. That's who monitors them all. And they are the ones who then report to the credit bureaus, Equifax and TransUnion. I'm led to believe that there is some kind of data interchange that happens twice a month. I don't know if that's true or not. I'm sure in the old days there was some tape that got sent somewhere and someone had to load it onto the mainframe. But I understand now it's done electronically. Maybe it's once a month. I'm not really sure. But it would end up being, so I mean, if your proposal ends this month, then by the end of next month, certainly the month after, it should be reflected on your credit report. So the fact that it wasn't reported on his credit report leads me to believe that either the credit bureau screwed up, which is very common, or the trustee hadn't yet for whatever reasons closed the file and reported it. But that was an obvious thing that was a miss.
Yes, I don't think that was the biggest contributor to his low score. Other things were several of the credit facilities that had been included in the proposal were still showing as owing balances, pretty much the money that was owed at the time that he filed the proposal. So if he had a $10,000 credit card, it might have been showing that he still owed $9,900. So that facility is showing very high utilization, and it's also showing that it was written off. In fact, some of these things were shown as bad debt or collection account or unable to locate the consumer, which was not
ridiculous
true.
because they were included in the proposal. But okay, what do you do then? And what you just described, I hear this story every day. Like, this is extremely common.
Mm-hmm.
All the
I
time.
do too.
All the time. This is nothing shocking at all what you're saying there. So what did he do about it? What did you do about it?
Well, first, I always tell people in these situations, you can, in fact, take matters into your own hands. You don't have to hire somebody and pay a penny to get them to do it. You don't need to be talking to a mortgage broker. If you're willing to do the homework, and you can prepare a package of information and send it to the credit reporting agencies, and there's two of them. It's Equifax and TransUnion Canada. You include your identification, 2 pieces, front and back, and you tell your story, and then you corroborate your story with documentary evidence. So in his case, he had to prove the proposal and the contents and which debts were included in it initially. And again, once he did that, then there should be no reporting balances. He also provided a copy of his completion certificate, which confirmed that the proposal had concluded. And in fact, I don't think it was in this case, but sometimes they say that there were late payments even after the proposal started, which is impossible because, as you well know,
point of the proposal.
At the moment they file, they get relief from their creditors. So sometimes it's very helpful to be able to send proof of payments that were made right up until the date that the proposal was filed. So they can do that, and they can send it by fax or they can send it by mail to both the reporting agencies. On average, it takes about a month to 6 weeks because the reporting agency will do an investigation. And it's not just they'll take everything at face value, they'll do an investigation, and they will correct whatever they think is an error.
And I assume you do that by filling out like the dispute resolution form or whatever.
You can, but it's not even necessary.
Just
I've helped
send them a
people over
letter.
the years, just send them a letter. And the easier you spell it out for them and just walk them through the process. They do hundreds of these all day, so the ones that are packaged nicely and well laid out, those are the ones that get their attention.
Yeah, here's 5 things wrong. Here's the 5 proof that they're wrong.
Now, as a mortgage broker, we have direct access to Equifax, and we're able to expedite that process for people that we're helping to get financing. And that was a huge win for Justin because time was of the essence, and he asked if we would mind taking care of that. So we put together a package of documents, and we presented the story, and we faxed it into Equifax, and within 2 or 3 business days, I got a phone call from Equifax confirming that every single thing that we challenged had been fixed or removed or replaced, and that we ran his credit report to submit with the mortgage application. And his score was no longer 497, it was 683.
Wow. From 497 to 683
in 3 days.
In 3 days. Obviously, it should never have been 497. That was the whole point. But it by correcting these errors,
Yes.
it fixed it. Well, it didn't fix it. It made it go way up, obviously.
Right. I mean, the proposal's still there. It happened. No one's denying it. It's not like his credit report is like a bed of roses. There's still historical facts. But there's enough goodness in there, too, to bring the score back up.
Now, the common conventional wisdom is you have to take steps to rebuild your credit. You have to establish new trade lines, new credit.
Absolutely. Very
Tell me
important.
about that.
Well, in the mortgage world, we have a rule, the 2 + 2 + 2 unofficial rule, which is basically from the time that you complete a proposal or a bankruptcy, you should try to have at least 2 credit facilities. They can be cards, they can be loans, they can even be a car payment. And if they're a credit card, the limit on it should ideally be at least $2,000. And you should have demonstrated at least 2 years of a perfect repayment history. That's what's supposed to get you back to the world of A or A- lenders. That's the journey.
In theory, that would give you a credit score potentially of in the 600, 650 range, something like that.
Well, it could do, but again, it really depends how you're using those cards. I mean, here's something. If you're trying to maximize your credit score, it may not be in your best interest to wait for your statement before you send in your payment, because
Just
your
pay
actual
quick.
balance will be high relative to the limit. So if you want to optimize your score, make sure you pay it off a few days before you expect your statement.
Gotcha. Yeah, I mean, again, in my book, in one of the chapters, I say, well, if you get paid every 2 weeks, why don't you just pay your bills every 2 weeks?
Absolutely. At least 2 payments a month. Why not? You know you owe it.
Yep. And the money's sitting there, so just pay it, and then you can never be behind. So what you've illustrated here then is credit history is important, certainly for a guy like Justin, who ended up then with a new first mortgage.
Yeah, we were able to go to an 80% loan to value, get him everything that he needed. The interest rate on the mortgage was excellent. I think it was a 2-year term, and the rate was 4.14 or 4.19%, 30-year amortization, and there was not even a lender fee associated with it. Often there is for these alternative mortgages, but his overall profile had strengthened so much, not just from what we did. I mean, he had good income, he had good employment, he had been rebuilding his credit with 2 new cards, but he hadn't had 2 years at it. He'd been doing that for about 10 months.
So he had taken some steps. So
yes.
People listening to this, and obviously they may be listening to this podcast months into the future. So you said a 4.14 whatever interest rate. If someone had had absolutely perfect credit, $1 million in the bank, never done a proposal, 50% loan to value, whatever, what would the perfect rate be?
You know what? That's a super question. I mean, refinance rates today are actually higher than purchase rates. So no matter what you see in the rate sites, they're higher.
Okay.
The going rate these days is around 3.39% for a 5-year fixed rate mortgage with a bank.
So he was paying somewhere between half a point and a point more, not even a full point more then.
Very minimal increase. Now, this was a very good result. Sometimes it will be a bit more than that. But still, the difference is much, much smaller than people think when they think about alternative lenders.
So then, to wrap this all up, give us your advice then. So someone's listening to us, and either they've got, if someone has a huge ton of debt, then of course my advice is going to be, well, you got to clean up the debt. You got to do a proposal, you got to pay it off, you got to do a bankruptcy, whatever. Let's assume they've done that. So they're kind of like Justin. They've got, a proposal that perhaps is completed. Obviously, their credit score is not perfect at that point. What advice would you be giving to someone who wants to be borrowing again, maybe wants to buy a house in a couple of years' time, that sort of thing? What are the steps you would be suggesting someone like that take to rebuild their credit?
I'd ask them first to get a copy of their personal credit history, and they can either go down to the Equifax office or the TransUnion office in Hamilton, and they can get a free copy of the report, or they can go online, create a user profile, and buy one. With Equifax, if they want to get their score, it's $23.95 for a one-time. They also have monthly options. Generally, I don't recommend monthly plans, but it can be useful for someone that's actively monitoring and trying to improve their score, at least for a period of time until they get to where they're trying to go. They can track their progress. And they need to be looking just at more than their score. These places that will allow you to track your score and nothing but your score aren't really telling you, remember we discussed at the beginning, the health of your credit history, what's inside it. Because that's what we're going to do when we see a copy of your credit report. We're going to look for errors. We're going to see that everything is the best it can possibly be for your unique circumstances. Just by taking attention to that, there's usually low-hanging fruit and a healthy increase to the credit score. That's the first step. And the second step is then giving you a program or some advice as to how to manage and maintain that credit history so that it will continue to increase in score each passing month. Time is always your friend when it comes to your credit history. Every month that you have best practices when it comes to managing your credit, your score is going to go up, even if it's just by a few points.
So clean up the errors, and then time. Time is a huge contributor.
But not just time. Some people think if I pay off my proposal, I'm good. I'll just wait 3 years and I'm fine. And they don't actually take the steps to rebuild with new credit. And lenders want to lend money to people that have demonstrated repayment capacity.
And that's where your 2 + 2 + 2 thing
right.
comes in.
You have to take out new credit facilities. No, you don't have to go back to the old days. And you know as well as I know, Doug, many people, when they've gone into a proposal or a bankruptcy, they vow, I'm never going to have a credit card again. It got me into trouble. I don't want to do it. But they have to reset that thinking. Some credit, to some extent, is healthy and necessary in today's society.
Yeah, it all depends on what your future plans are. If you're 80 years old and you rent an apartment, okay, then I don't think it's necessary. But if your goal is, I want to finance a car someday, I want to buy a house, then you're going to have to do things to improve it. So
absolutely.
Excellent. Well, I appreciate that, Ross. That's a great place to end it. Now, let me say what I've said on this show many times before, and that's that this show is not a commercial for any of my guests. Guests can't pay to be on the show. There are no affiliate links. I don't get paid a kickback if a listener uses Ross's services. However, since you are here, and there may be people who want to talk to you, how can they get in touch with you? How do they find you?
Well, a couple of easy ways. We have a super easy phone number. It's 416-989-1000. Or they can email me, Ross, at askross.ca. That's the website. That's where you'll find over 500 articles that I've published in the last several years, many of them about circumstances just like Justin's. Case studies of real-life situations and how people were able to improve their circumstances.
And the primary person that you can help is who? Tell me who that person is.
Well, I love all mortgages, and it's really nice when I get a AAA client knocking on my door and saying, I'm perfect, can you get me a good mortgage? Absolutely. But the reality is I'm targeting homeowners with debt or credit problems or hard to verify income. There's a big percentage of people out there that don't really know where to turn. And there are solutions, and there are mortgage brokers that specialize in that. It's a more difficult niche, but it's one that if you understand it, can be very rewarding and very, very helpful to the people that think they've got nowhere to turn.
Right. So they start with you. And obviously, one of the points of a mortgage broker is you've got many different lenders you can go to. If you go to the bank, you're only going to the bank, and that's that. So in Justin's case, how much did he have to pay you?
When we did the second mortgage, I charged him a brokerage fee.
But that was during the proposal period to get it.
We had to charge a brokerage fee because the private lenders don't pay brokers. So
but when you did the renewal one,
we did the renewal, I also charged him a brokerage fee. And I did that in recognition of the overall service that we've been providing for the last year, in addition to the credit repair service.
And so in rough terms, if I'm what you called a B-level client, so somebody who's got maybe a proposal in their past or some other things, what kind of dollars am I looking at to come in and use someone like you to help clean me up? I mean, obviously you did a bunch of things. You were on the phone with Equifax. You were giving, so it wasn't just here. You filled out a mortgage application form. Are we talking like a couple of $1,000? Are we talking? Every situation is different. Like what's the range someone could?
Every situation is different, and I have a sort of going in assumption that we will do somebody for $995. I just did one this week where it was $495. It was a fairly simple case. And sometimes when it's a couple and it's complicated and they had two unique proposals, we might even be looking at a little bit more. It also depends, too, as to whether or not we're doing any other business for them. I mean, obviously, if we're doing a mortgage where we can receive some compensation, then we're more likely to be generous on the...
And that would be fairly typical. Like you said, with a private mortgage person, they're not paying any kind of fees.
No.
But if it's one of the bigger companies, then there is some kind of compensation that gets paid to the mortgage broker in a lot of cases?
Yes, in a lot of cases, yes.
And that would be built right into the mortgage?
Correct.
So I'm paying 4.14%. Some of that money ends up going to the person who lined up the mortgage.
Yes, although not to the same extent that it would be as if we were dealing with an A client. It's just the process is a little bit different. So these alternative lenders will often charge a lender fee. It's important to note for people. Again, in some cases it can be built into the mortgage. And that lender fee might be as much as, say, 1% of the loan amount. And then the individual mortgage broker helping them might charge anywhere from, say, nothing to 1% of the loan amount also, depending on the complexity of the circumstances.
So if I'm a customer, I should ask questions.
Absolutely. You should not be finding out about these at the last minute. These are always gone through right at the beginning because it's such an important part of the process. They need to understand what they might be spending and whether or not it makes sense for them.
Yeah, and I think that's the key. Does it make sense for them? So we talked about Justin's situation. Well, based on what you said, it made sense for him. He lowered the payment he was making in the proposal. He's ended up in a much better situation than he was. Obviously, the story may be different if we talk 5 years from now, if real estate doesn't keep going up in value and things are different. But I think that's key, that you gotta look at each individual situation and go into it with your eyes open. In his case, needing some additional funds because of the medical issues and so on, it all kind of made sense. So. Excellent. Well, I think that's fantastic. Ask questions, and you should certainly be doing that if you're coming in to see me too. Don't just blindly take what I'm talking about. So, excellent. Well, I appreciate that, Ross. That's our show for today. I'm going to put links to everything we talked about today in the show notes over at hoys.com, including a link to Ross's website, which is askross.ca, and a link to the case study he wrote about how he helped his client Justin that we've been talking about, who improved his credit score so he could qualify for a much better mortgage. The show notes will also have a full transcript. And if you want to read the book, including Chapter 4 that got this entire discussion started, the book is called Straight Talk on Your Money, and it's available at better bookstores across Canada and online at amazon.ca and indigo.ca, and it's also a Kindle and Kobo ebook, and it's an audiobook on Audible and iTunes. Thanks for listening. Ross, thanks for being here.
My pleasure, Doug.
Until next week, I'm Doug Hoyes. That was Debt Free in 30.